If you are currently receiving Social Security benefits, or if you are planning to claim them soon, stop what you are doing and pay close attention. Starting May 15th, 4 significant rule changes are taking effect that could quietly reduce how much money arrives in your bank account each month. Most people will not hear about these changes from the government. No letters, no announcements, no public outreach. By the time many recipients notice something is different, the impact will already have occurred. We are talking about real dollars here, potentially hundreds each month for some people, and thousands over a full year for others. Retirees living on fixed incomes, Americans receiving disability benefits, and surviving spouses collecting survivor payments are among those most likely to be affected. These changes are real, documented, and already approaching. Stay with me through this entire video because I am going to walk you through all 4 of them, what each one means, who it affects, and what steps you can take right now to protect yourself. And one more thing before we dive in. Rule number 3 is the one that is catching people completely off guard. Even financial advisors are reporting that their own clients had no idea it existed. Do not skip ahead because understanding how all 4 connect is essential. Let us get into it. Here is something most Americans do not fully appreciate about Social Security. It is not a fixed, unchanging program. The rules governing your benefits, when you can claim, how much you receive, what causes a reduction, what triggers an increase, those rules are updated regularly. Sometimes changes come from Congress. Sometimes they come from Social Security Administration policy updates. Sometimes they are tied to cost of living calculations or coordination with the IRS. And sometimes, adjustments move through with almost no public announcement whatsoever. May 15th is one of those moments. 4 separate rule changes are going into effect at the same time. When multiple changes arrive simultaneously, the combined effect on your benefit calculation can be substantial. Let me walk you through the first one. Rule number 1 involves how the Social Security Administration is now handling income verification for recipients who also work part-time. This has always been a complicated area, but the new 2026 enforcement standards are more rigorous than anything we have seen in the past decade. Here is the situation. Under the previous framework, if you were collecting Social Security before reaching your full retirement age, and you also had some part-time earnings, perhaps a small job, freelance work, or occasional consulting, the SSA allowed a certain amount of income before it began reducing your benefits. That threshold is called the Retirement Earnings Test. While that test still exists, the way the SSA verifies and enforces your reported income is changing significantly starting May 15th. The SSA is now cross-referencing earnings data in real time using IRS records, state wage reports, and third-party payroll processors. The previous gap, where someone might have unreported income go undetected for a year or 2, is rapidly closing. The system is becoming automated, and if a discrepancy is identified, the SSA can now initiate a benefit adjustment without waiting for your annual tax return to reconcile the numbers. For recipients who accurately report their income, this is not a problem. But here is where things become complicated. If your work situation changed recently, you picked up a gig, received a one-time payment, or sold something of significant value, and you did not report it because you were unsure whether it applied, you could be flagged. Once flagged, you may face an overpayment determination, meaning the SSA may request reimbursement for benefits already paid to you. Please note, this video is for informational purposes only and does not constitute legal or financial advice. For guidance specific to your situation, consult a licensed professional or contact the SSA directly. Overpayment recovery requests have been among the most financially disruptive situations hitting retirees in 2025 and 2026. People are receiving notices stating they owe $3,000, $5,000, even $10,000 back to the government with no prior warning. So before May 15th, if you have had any part-time earnings, freelance income, or any income of any kind, log into your My Social Security account and confirm your records are accurate and up to date. That is Rule 1, and it is already affecting real recipients right now. Rule number 2 involves a change in how survivor benefits are calculated. And this one carries significant weight because it directly affects widows, widowers, and in some cases, surviving children. For years, advocates identified what they described as an inequitable offset rule. If a surviving spouse received their own Social Security retirement benefit and also qualified for a survivor benefit based on their deceased spouse's earnings record, the two amounts did not fully combine. You received the higher of the two, not both. This meant millions of surviving spouses, many of them women who stepped away from the workforce to raise families, were receiving less than they were entitled to. The 2026 adjustment does not eliminate this offset entirely, but it does revise the calculation threshold in a way that allows a portion of both benefits to be received at the same time, depending on your age when your spouse passed, the difference between your respective earnings records, and whether you have already reached your own full retirement age. This may sound technical, but the bottom line is straightforward. If you are a surviving spouse currently receiving only one benefit, either your own or your late spouse's, you may now qualify for a supplemental amount you have been missing. Some beneficiaries could see an additional $80 to $300 per month that they were not aware they were entitled to. The important detail is that the SSA will not automatically recalculate your benefit. You must contact your local SSA office directly and specifically request a survivor benefit review under the updated 2026 calculation rules. Do not delay, because for each month you wait, that is money you may not be able to recover beyond a limited look-back window. Stay with me, because rule number 3 is the one I mentioned at the beginning, and it is genuinely important. Rule number 3 affects a group that is already facing financial pressure. We are talking about Americans who receive Social Security Disability Insurance, known as SSDI, and who have recently received a financial gift, an inheritance, a legal settlement, or any kind of lump sum payment. Here is what is changing. The SSA has updated its asset monitoring process for SSDI recipients as part of the 2026 Federal Budget Reconciliation Framework. Previously, asset oversight for SSDI was applied somewhat loosely, particularly for recipients who were not also enrolled in SSI, which carries its own separate and stricter asset limits. Starting May 15th, a new data sharing arrangement between the SSA, the IRS, and participating financial institutions means that large deposits into SSDI recipient accounts may trigger an automatic eligibility review. To be clear about what this means in everyday terms, if a parent recently passed away and left you $30,000, if you received a modest settlement following an accident, or if a family member provided you with a substantial financial gift, any of these situations could now prompt a review of your SSDI eligibility. Even though SSDI, unlike SSI, does not carry a formal asset limit, the concern is not the asset itself. The issue is that a sudden increase in funds can affect your status in other ways, particularly if the SSA questions whether it reflects a return to substantial gainful activity, or whether it influences your household income in ways that affect Medicare premium calculations. The review process itself can be disruptive. It can delay your payment while verification is underway, and it can create an administrative process that takes months to resolve. For someone living on a limited budget, a delayed SSDI payment is not simply an inconvenience. It can create a genuine hardship. What should you do? If you have received any lump sum funds in the past 6 months, or if you are expecting any, speak with a benefits counselor before May 15th. Free SSA Work Incentive Planning and Assistance Programs, known as WIPA programs, are available in every state. They can help you understand how to manage a financial change without unintentionally triggering a review that disrupts your benefits. Very few people in the disability community are aware of this yet, which is precisely why this information matters right now. Disclaimer: this content is educational and informational only. Please consult a qualified benefits counselor or SSA representative for advice tailored to your individual circumstances. Now let us talk about rule number 4, because this one touches the largest number of people. We are talking about tens of millions of Social Security recipients across all categories. The fourth rule change involves how the SSA applies cost of living adjustments, commonly known as COLA, in relation to Medicare Part B premium deductions. Each year, Social Security recipients receive a COLA increase intended to help their payments keep pace with inflation. In theory, the hold harmless provision is supposed to protect recipients from having their benefit reduced when Medicare premiums rise. In practice, that protection only applies under specific circumstances, and the 2026 changes have revised how those circumstances are defined. Specifically, the updated rules adjust the income thresholds used to determine your income-related monthly adjustment amount, known as IRMAA. This is the additional premium that higher-income Medicare recipients pay on top of standard Part B and Part D premiums. Those thresholds have been recalculated using updated modified adjusted gross income figures based on your 2024 tax return. Here is where many retirees are being caught off guard. If you had a higher-than-usual income in 2024, perhaps from selling a rental property, taking a large IRA distribution, or realizing a one-time capital gain from a home sale, that income spike, even if completely temporary, even if your 2025 income returned to normal, can place you into a higher IRMAA tier. Starting May 15th, that means a larger Medicare premium deduction coming directly out of your Social Security payment. Potential increases range from approximately $69 per month at the first tier to as much as $419 per month at the highest tier, per person. For married couples where both spouses are enrolled in Medicare, those figures may double. But here is something many recipients do not realize. You can appeal this determination. If your income dropped meaningfully from 2024 to 2025 because of a one-time event, you have the option to file a life-changing event appeal with the SSA using Form SSA 44 and request that they use your more recent, lower income figure instead. If approved, your premium is reduced. However, you need to file before the adjustment takes effect. Once the higher amount begins being deducted from your payment, recovering those previous months becomes significantly more difficult. Please consult a licensed tax professional or financial advisor before taking action on IRMAA appeals, as individual situations vary. Now let us bring all four of these together, because what is important to recognize is that these changes are not isolated. They reflect a broader pattern of the federal government strengthening oversight, closing data verification gaps, and placing more responsibility on individual recipients to monitor their own status rather than relying on proactive outreach. The SSA is not a personal financial advisor. The agency will not reach out to let you know that something in your file may be affecting your benefit. The system is largely reactive. Something triggers a review, and the SSA responds, often months later, often with a payment adjustment you were not expecting. The recipients who avoid these situations are the ones who stay informed, ask the right questions, and do not assume that receiving consistent payments means everything is in order. If you are a retiree who has been receiving your benefit without interruption, that is a good sign. But take 15 minutes this week to log into your My Social Security account at ssa.gov. Review your benefit summary. Confirm your earnings record. Verify that your Medicare premium information is accurate. If anything appears inconsistent, contact the SSA directly at 1-800-772-1213. If you are a surviving spouse, call and specifically request a survivor benefit review under the updated 2026 calculation rules. If you are receiving SSDI and have experienced a financial change in the past year, connect with a WIPA counselor before May 15th. And if you are a Medicare recipient who had an elevated income year in 2024, review your 2026 Medicare premium notice and determine whether filing an SSA 44 appeal is appropriate for your situation. These steps require some time, but the alternative, discovering after the fact that your payment has been reduced or that you are being asked to repay thousands of dollars in overpayments, is far more difficult to navigate. Here is an honest assessment of where things stand. The Social Security system is operating under significant pressure in 2026. Demographic trends, inflation, and ongoing policy discussions over program funding are all contributing to an environment where rules are being revised regularly, often without broad public communication. And the people most affected by these gaps in awareness are consistently the same groups: retirees on fixed incomes, Americans living with disabilities, and surviving spouses who dedicated their working lives to earning every dollar of these benefits. You deserve to have this information. That is why this video exists. Share it with someone who needs it. Your neighbor who recently lost their spouse, a parent who has been on SSDI for years, a friend who retired in 2024 and does not yet know their Medicare premium may be increasing. If this video was helpful, please hit the like button. It lets us know this type of content is reaching people who need it. Subscribe so you do not miss future updates, because these rules will continue to evolve and we will continue tracking them for you. And leave a comment below telling us which of these 4 rules was most surprising to you. We read every single one. There is another video right here covering 3 IRS changes affecting retirees this summer. Watch it next, because what is happening with required minimum distributions in 2026 is something you will want to understand before July.